You might have noticed that almost everything feels more expensive right now, but for thousands of retirees, that inflation shock has triggered a genuine financial emergency. Seniors are opening letters from the Social Security Administration to discover their Medicare Part B premiums have doubled or even tripled. This is not a clerical error. You are looking at the mathematical reality of the 2026 IRMAA brackets. The government is applying a deliberate surcharge to your health insurance, and it is triggered by the exact income you reported 2 years ago. This chart shows how the system is structured. The standard Medicare Part B premium sits right here at $202.90 a month. That is your baseline. The trap activates when you cross specific income tiers. If you are a single filer with a modified adjusted gross income of $109,001, crossing the line by a single dollar, you trigger a massive penalty. You immediately owe an extra $974 in annual surcharges. For joint filers, the threshold sets at $342,001. Hit that mark, and the government tacks on nearly $4,870 per person to your yearly costs. The danger here lies in the delay. A routine property sale or a standard Roth conversion that made perfect financial sense in 2024 is now acting as an invisible tax on your healthcare in 2026. Every dollar drained by these avoidable surcharges is a dollar pulled directly from your premium healthcare budget. You are paying a penalty simply for managing a successful retirement portfolio, forcing you to drain your assets faster than planned. To fix this, we have to exploit the logistical lag built into the system. The government uses a mandatory 2-year lookback, which means your 2026 premiums are legally bound to your 2024 tax returns. The Social Security Administration doesn't track your daily finances. They pull their data directly from the Internal Revenue Service, relying on tax files that are completely disconnected from your current situation. Pull your 2024 tax return. Look specifically for your Modified Adjusted Gross Income, or MAGI. You need to know the exact number the government is using against you. Now compare that figure to what you are actually living on today. If your current income has dropped since 2024, you are caught in a logistical mismatch. The government is charging you based on peak earning years, not your retirement reality. Verifying this specific data gap is your first actionable step. We must document that their assessment is based on a financial reality that no longer exists. You cannot simply ask the government to lower your premium. You must force an IRMAA reset using the one legal mechanism they recognize, a life-changing event. The rules are rigid. You must prove you experienced a work stoppage like retiring, a reduction in hours, or the loss of income-producing property. Do not claim high personal expenses or stock market losses. The government explicitly excludes market volatility and personal spending habits from qualifying as life-changing events. Timing is the deciding factor. The event must have taken place after you filed those 2024 taxes to directly challenge the 2026 assessment. When you identify a valid event and assemble your proof, you aren't asking for a favor. You are executing a legal mandate that the Social Security Administration is required to fulfill. Your tool to execute this mandate is Form SSA-44. This is the exact paperwork you submit to the Social Security Administration to challenge their math. When you fill it out, direct your attention to the current year fields. This is where you overwrite their outdated numbers with your actual reduced income figures. Next, move up to Step 1. Carefully select the exact checkbox that corresponds to the documented proof you gathered earlier, aligning your story with their strict categories. To prevent this from happening again, you have to control your taxable income moving forward. Health savings accounts allow you to pay for medical expenses tax-free, entirely shielding that cash from your future MAGI calculations. If you are taking mandatory portfolio withdrawals, use a qualified charitable distribution. Routing money directly from your IRA to a charity satisfies your withdrawal requirement without a single dollar touching your adjusted gross income, keeping you safely below those threshold cliffs. Filing this form correctly strips away the penalty. It resets your premium, aligning your healthcare costs with your actual retirement reality. The moment that appeal is processed, the bureaucratic leak in your portfolio is sealed. You stop hemorrhaging cash to an outdated math formula. Take those recovered funds and deploy them where they actually matter. Reinvest in advanced longevity screenings, physical therapy, and premium supplement protocols to keep you active through your 80s and 90s. Fixing your Medicare premium secures your short-term cash flow, but your long-term capital is still exposed to a much larger threat. A single long-term nursing home stay regularly exceeds $120,000 a year. If you wait until a health crisis hits to protect your assets, the Medicaid look-back period will severely penalize your family, seizing savings you thought were perfectly safe. Protecting your estate requires a structural defense strategy implemented years in advance. Let's move straight into the next breakdown on mastering long-term care, so you can shield your life savings without ever running out of cash.